If you've ever wondered how to balance making money and avoiding losses, this is the video for you. Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're diving into a concept that's at the heart of every investment decision: risk versus return. By the end of this, you'll know exactly what risk and return mean, how they're connected, and how you can use this knowledge to make better financial choices. So let's dive in. Okay, so what exactly is risk versus return? Well, in simple terms, risk is the chance of losing money on an investment, while return is the reward you can get for taking the risk. The higher the risk, the higher the potential return, but also the higher the chance you could lose money. On the flip side, lower risk investments are safer, but they usually come with lower returns. So let's put this into perspective with an example. Imagine you have £1,000 to invest, and you have two options. You could put it in a savings account that pays 1% interest. It's super safe because the bank guarantees your money, but your return will be small, just £10 after a year. Or you could invest it in, say, stocks. Stocks have the potential to earn you, say, 8 to 10% or more in a year, but there's also a chance that the value could drop, and you could lose some or all of your investment. This is the risk-return trade-off. To earn higher returns, you usually have to take on more risk. Now let's talk about how risk and return are connected. In finance, risk isn't always a bad thing. It's more about understanding how much uncertainty is involved in an investment. Higher risk investments like stocks, cryptocurrencies, or startups can deliver bigger returns, but only if things go well. Lower risk investments like bonds, savings accounts, or government securities are much more predictable but won't make you rich overnight. Think of it like driving a car. A slow, steady drive gets you to your destination safely. That's like a low risk investment. But if you decide to drive fast and take shortcuts, you might get there quicker or you might crash. That's a high risk investment. So how do you decide what's right for you? It all comes down to your risk tolerance. Risk tolerance is your ability and willingness to handle potential losses. For example, if you're young, with a stable job and no big financial commitments, you might have a high risk tolerance. You can afford to take bigger risks because you have time to recover from those losses. On the other hand, if you're close to retirement or saving for a house deposit, you might have a low risk tolerance. In that case, protecting your money is more important than chasing big returns. Now, here's an important point to note. Risk and return don't always follow a straight line. Just because something is more risky doesn't mean it'll automatically give you higher returns. That's where smart investing comes in. So here's a quick tip to manage risk versus return: diversification. Diversification means spreading your investments across different assets like stocks, bonds, real estate, and even savings accounts. The idea is that if one investment performs badly, others might do well, balancing out your overall risk. For example, if you put all of your money into one tech stock and that company has a bad quarter, your entire portfolio could take a hit. But if you invest in a mix of tech, healthcare, and energy stocks, or even add bonds to the mix, you reduce the impact of one bad investment. So let's recap. Risk is the chance of losing money, return is the reward for taking that risk. Higher risk can lead to higher returns, but also bigger losses. Lower risk is safer, but comes with smaller returns. Your risk tolerance depends on your financial goals, age, and personal comfort with uncertainty. Diversification is a powerful tool to balance risk and return. So how can you apply this in real life? Start by asking yourself a few questions. What are you investing for? Retirement, a big purchase, general wealth building? How much risk are you willing to take to achieve those goals? Are you comfortable with short-term losses if it means long-term gains? Understanding your answers to these questions will help you choose investments that align with your goals and risk tolerance. And that's it. Risk versus return explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.